Look at your screen. As of late 2024, the spot price of silver suggests a market of plenty, but behind the digital tickers, a different reality is hardening. While paper contracts trade by the billions, the actual physical vaults tell a story of depletion. Recent COMEX filings show a persistent migration from registered to eligible categories, indicating that while silver exists, it is increasingly not for sale at these prices. Industry reports from the World Silver Survey suggest a multi-year supply deficit that the market has yet to price in. Meanwhile, the Eastern drain is accelerating, with Shanghai premiums frequently gapping above Western benchmarks. If history serves as a guide, this decoupling between paper promises and physical tangibles represents a historical mean reversion. The snap isn't just a prediction. For many macro analysts, the divergence between a digital price and physical availability is becoming a mathematical inevitability. The illusion of abundance is fading. To understand where we're going, we have to look at the rubber band of the precious metals market, the gold-silver ratio. Think of this ratio as a measure of tension. Historically, for every ounce of gold, the market has valued silver at a specific multiple. But today, that rubber band is stretched to a point that historically precedes a violent snapback. As of late 2024, the ratio sits near 80 to 1. The current divergence represents a significant historical anomaly. Gold is currently trading near all-time highs, reflecting global debt concerns and record central bank buying. Yet silver, despite its critical industrial role in the green energy transition and a tightening supply-demand balance, remains significantly below its nominal 1980 and 2011 peaks. Many macro analysts argue this isn't just a pricing laggard, it's a decoupling of value from price. If history serves as a guide, when the ratio reaches these extremes, it doesn't just drift back, it mean reverts with speed. For the ratio to return even to its modest 20-year average of 65 to 1, silver would need to outperform gold significantly. This elasticity is the fundamental tell of the market. The further the paper markets stretch the price away from physical reality, the more energy is stored for the eventual reversion. The tension is visible. The question is when the snap occurs. To understand why the price on your screen often fails to reflect the reality of the market, you have to look at the COMEX inventory shell game. In the vaults of the commodity exchange, silver is divided into two distinct categories, registered and eligible. Eligible silver is metal that meets exchange requirements, but is owned by private parties. It is simply being stored, not offered for sale. Registered silver, however, is the only metal actually available for delivery to satisfy futures contracts. As of late 2024, data from CME group filings reveals a troubling trend. The registered category, the liquidity lifeblood of the exchange, has seen a persistent drain. We are witnessing a migration where silver is moved from registered to eligible or withdrawn from the vaults entirely. Industry analysts suggest this shift occurs because bullion banks and private owners are increasingly unwilling to surrender physical metal at today's suppressed paper prices. This leads us to the paper tower, a structure built on the shaky foundation of rehypothecation. In the digital futures market, the volume of silver traded daily vastly exceeds the physical metal held in registered vaults. At any given moment, there may be dozens, if not hundreds, of paper claims for every single ounce of physical silver available for delivery. This leverage creates an illusion of abundance. However, the structural integrity of this tower depends on the assumption that most traders will settle their contracts in cash rather than demanding the physical bars. Recent August 2024 filings indicate that this assumption is being tested. As the Eastern drain pulls physical assets toward Shanghai, where premiums are higher, the Western vault system is being hollowed out. If even a small percentage of paper contract holders suddenly demanded physical delivery, the discrepancy between the paper price and physical availability would be exposed. This isn't merely a theoretical risk, it's a mechanical one. When the ratio of paper to physical becomes too skewed, the system faces what macro analysts call a delivery squeeze. The shell game relies on the hope that the music never stops. But as the registered inventory continues to dwindle, the number of chairs in this game is disappearing. For those watching the flow of metal rather than the flicker of the ticker, the conclusion is clear. The paper market is writing checks that the physical vaults may soon be unable to cash. The divergence between digital promises and tangible assets is no longer a hidden secret. It is a structural reality that defines the current silver landscape. In the world of commodities, there's a fundamental law. When prices go up, supply follows. If oil hits $150, drillers rush to the shale fields. But silver is an anomaly that defies this logic. This is what industry insiders call the byproduct trap. And it is the reason why a price explosion won, to be met by a wave of new supply. According to the World Silver Survey 2024, approximately 70% to 75% of the world's silver is not mined directly. Instead, it is a passenger metal, a byproduct recovered during the extraction of copper, lead, and zinc. Because silver is effectively a secondary windfall from massive base metal operations, its production is tied to the demand for industrial pipes and galvanized steel, not the investment demand for precious metals. This creates a massive structural problem. Silver supply is almost entirely inelastic. If the silver price doubles tomorrow, a copper miner in Chile or a zinc miner in Australia is not going to spend $2 billion to build a new mine just to capture the silver bonus. They only increase production if the market for their primary base metal justifies it. This means that even in a historic silver shortage, the driver of the mine, the copper or zinc, remains in control, leaving silver as a helpless passenger. Furthermore, we are facing the reality of declining ore grades. Historical data from major mining hubs suggests that the concentration of silver found in base metal deposits has been in a steady, decades-long decline. We are quite literally digging more earth to get less metal. As of late 2024, industry reports indicate that even as copper demand for electric vehicles surges, the silver head grade in those same mines is often falling, meaning the byproduct yield is not keeping pace with industrial needs. Analysts suggest that even for the remaining 25% of primary silver mines, the lead time to bring a new project from discovery to production now averages 10 to 15 years. Environmental regulations, permitting hurdles, and a lack of major discoveries mean that the supply spigot is effectively rusted shut. When the delivery squeeze intensifies, there is no emergency reserve of mines waiting to save the market. The silver that exists is all there is, and no matter how high the price goes, the earth will not give it up any faster. While the West struggles with declining ore grades and inelastic supply, the market's geographic center of gravity is shifting. We are witnessing what macro analysts call the Eastern Drain. To understand this, you have to look at the Shanghai premium. As of late 2024, data indicates that silver on the Shanghai Gold Exchange, SGE, frequently trades at a significant markup compared to the LBMA in London or the COMEX in New York. This isn't just a minor discrepancy. At times, the premium has widened to over 10%. This creates a massive arbitrage vacuum. Traders are incentivized to buy physical bars at the lower Western paper price, ship them east, and sell them instantly for a profit. The result is a relentless one-way flow of metal. Industry reports suggest that hundreds of millions of ounces are migrating from Western vaults to Eastern exchanges. Unlike the Western system, which is built largely on rehypothecated paper contracts, the Eastern markets, specifically in China and India, are increasingly driven by physical delivery. They aren't interested in digital promises, they want the metal in hand. This trend is being compounded by a new geopolitical reality, the weaponization of supply. Analysts suggest that recent shifts in export policies among BRICS-aligned nations indicate a strategic move to starve Western exchanges of physical liquidity. By restricting the flow of silver out of their borders while simultaneously draining Western vaults via arbitrage, these players are effectively forcing a decoupling of the physical market from the digital spot price. If historical mean reversion serves as a guide, the transition from a paper-based pricing system to a physical-based one is rarely a smooth process. As of late 2024, the widening divergence between the SGE and the COMEX is a flashing red light. It suggests that the West is losing its ability to dictate the price of a metal it no longer physically possesses. The Eastern Drain is more than a trade imbalance. It is a systematic dismantling of the paper-silver market, one bar at a time. While the headlines tout resilient growth, macro analysts are increasingly looking past the surface of gross domestic product. They argue that GDP has become a ghost metric, a debt-fueled hallucination that obscures the structural decay of the underlying economy. To understand the silver market, you must first understand that the growth we see in the West is largely an accounting trick. As of late Q3 2024, the United States national debt has surged past $35 trillion. The critical observation isn't just the total, but the trajectory. Recent Fed data suggests that the US is currently adding $1 trillion in debt roughly every 100 days. When government spending, funded entirely by deficits, becomes a primary driver of GDP, the resulting growth figures aren't a sign of industrial productivity. They're a byproduct of currency debasement. The math is reaching a breaking point. Trailing 12-month data indicates that the federal interest expense has surpassed $1 trillion annually, now rivaling the defense budget and consuming a staggering percentage of tax revenue. In this environment, every dollar of growth is being purchased with multiple dollars of new debt. This is not an economic expansion. It's a liquidation of future purchasing power to maintain a present-day illusion. For those monitoring these ghost metrics, the priority shifts from speculation to a wealth preservation hedge. If history serves as a guide, when a currency is sacrificed to sustain the appearance of growth, physical assets with no counterparty risk become the ultimate insurance policy. While the GDP counts every paper transaction as progress, it ignores the systemic insolvency of the currency itself. Analysts suggest this creates a scenario where silver becomes a vital exit ramp. Unlike the dollar, silver cannot be printed into existence to balance a federal budget. As the gap between real-world productivity and debt-fueled statistics widens, the snap toward historical mean reversion suggests that tangible, physical assets may soon be the only metrics that hold their value. Understanding the structural decay of the currency is one thing, surviving the market's price action is another. For those holding physical assets, the primary challenge isn't the supply deficit, it's the volatility gauntlet. As of late 2024, the discrepancy between the paper spot price and physical reality has reached a fever pitch. Macro analysts suggest that institutional shorts frequently use high-frequency paper dumps to defend their positions. These events often occur during low liquidity windows, whereas paper ounces, representing metal that does not exist in physical vaults, are sold in massive volumes in a matter of seconds. These price smashes are designed to trigger retail stop-loss orders and incite psychological panic, a phenomenon market veterans call a shakeout. Recent August 2024 COMEX filings show a continued migration from registered to eligible inventory, suggesting that while the digital price may plummet, the physical supply is steadily tightening behind the scenes. Industry reports indicate that these paper-driven dips are often utilized by institutional players to acquire physical metal at an artificial discount from panicked retail holders. If history serves as a guide, this volatility is the final barrier to entry. Analysts suggest the gauntlet is a mechanism to separate the weak-handed from their physical assets before a decoupling event occurs. To survive, one must recognize that the paper price is a reflection of digital sentiment, not physical scarcity. In this environment, the focus shifts from speculative timing to a disciplined wealth preservation hedge, ignoring the paper noise in favor of physical weight. As of late 2024, the widening gap between the COMEX paper price and the physical reality of the Eastern Drain presents a critical self-assessment for every observer. Analysts suggest the ultimate question isn't where the price goes tomorrow, but what sits in your vault today. Are you positioned in paper promises, digital contracts subject to institutional price smashes, or in the physical weight of an asset with no counterparty risk? As historical data indicates a continued migration of metal into private hands, experts ask, which side of the delivery squeeze will you be on when the decoupling is complete? For more macro analysis, subscribe now.